So, you've probably been told that making money in the market is simple, right? Buy low, sell high. But what if I told you that's just scratching the surface? Like playing checkers when there's a whole chessboard waiting. Today, we're diving into options trading. This is a toolkit that lets you build a strategy for pretty much any market move or lack of one. It turns that boring one-way street into a huge open landscape of possibilities. Yeah, let that one sink in for a second. We're all wired to think that to make money, something has to move. The price has to go up or it has to go down. But what if you could actually turn a profit from a market that just sits there, goes absolutely nowhere? It sounds kind of crazy, but it's not only possible, it's a key part of options trading. And that's just the first rule we're going to throw out the window today. So here's our game plan. We're going to start with the basics, going beyond just up or down. Then we'll get into the secret sauce, volatility. After that, we'll meet the so-called Greeks. Don't worry, it's not as scary as it sounds. Then we'll open up the strategy playbook. And finally, we'll cover the unspoken rules that really separate the pros from everyone else. Sound good? Let's jump in. All right, section 1. Before we can build these crazy, sophisticated strategies, we got to understand the two fundamental building blocks. Think of them like the two most basic Lego bricks in the entire options world, the call and the put. Seriously, every single strategy, no matter how complex it looks, is just some combination of these two. Okay, first up, we have the call option. Here's the deal. Buying a call gives you the right, and this part is crucial, but not the obligation to buy a stock at a price you've already agreed on. That's the strike price. It's basically your go-to move when you're super bullish, you think a stock is about to blast off. It's an awesome way to get in on that potential upside without having to buy all the shares outright. And then you've got its opposite, the put option. A put gives you the right to sell a stock at a set price. This is your weapon of choice when you're bearish, when you think a stock is headed for a dive. So it's pretty simple, right? Calls for when you think it's going up, puts for when you think it's going down. These are our basic directional bets. But here's where things get really interesting. See, an options price isn't just about which way the stock is going. No, it's driven by something way more powerful, and that's volatility. The best way to think about it is like the market's weather forecast. Are we looking at clear skies and calm seas ahead, or is there a hurricane brewing on the horizon? And you've got to understand there's a huge difference here. You've got historical volatility, which is like looking in your car's rear-view mirror. It tells you how bumpy the road was. But options are all about the future. They're priced using implied volatility. That's the market's collective guess about how bumpy the road is going to be. It's all about what we expect to happen. And this brings us to one of the most important ideas in all of options trading. When you buy a call or a put, you're not just betting on direction. You're making a bet that the market weather is going to get way stormier than everyone else thinks. And when you sell an option, you're betting on things staying calm or getting calmer. So let me say that again because it's that important. Trading options is trading volatility. Okay, so if we're juggling all these things at once, the price, the time, the volatility, how in the world do we keep track of our risk? Well, that's where the Greeks come in. And look, I know the names sound intimidating, but please don't get hung up on that. They're not some crazy math equations you need to solve. Just think of them as gauges on your car's dashboard. They're there to tell you exactly what's going on with your trade at a glance. First up is delta. This is your speedometer, plain and simple. It tells you how much your options price is expected to move for every single $1 change in the stock price. So a delta of, say, 0.50, that means your option's going to gain about 50 cents in value if the stock goes up by a buck. It's your number one gauge for directional risk. Next, we've got Vega. So if delta is your speedometer, think of Vega as your weather radar. It's measuring how sensitive your option is to changes in that market forecast we talked about, the implied volatility. If you have a positive Vega, your position actually makes money when things get crazier, when that uncertainty in the market goes up. And finally, there's Theta. Okay, this is the one that gets almost every beginner. Theta is like a relentless countdown clock. Every single day that goes by, your option loses a tiny little bit of its value just because time is running out. We call this time decay, and it's the constant enemy of anyone who buys an option, but it's the best friend of anyone who sells one. So let's do a quick check on our dashboard. Delta, that's your speedometer, telling you how sensitive you are to the stock's price. Vega, that's your weather radar, tracking how you're affected by changes in volatility. And Theta, your fuel gauge, showing that constant, steady burn of time decay. You get these three, and you're way ahead of the game in managing your risk. All right, perfect. So now we've got our Lego bricks, our calls and puts, and we've got our risk dashboard with the Greeks. So let's open up the playbook and see how we can start snapping these pieces together to build some really cool strategies for specific situations. Okay, picture this. A company's about to release their earnings report. You have this feeling in your gut. This stock is going to make a massive move. The problem is, you have no clue if it's going to shoot up or crash down. That's the perfect setup for a straddle or a strangle. With a straddle, you buy both a call and a put at the exact same strike price. Now it's a bit more expensive, but you start making money quicker. The strangle is kind of its cheaper cousin. You buy a call at a higher price and a put at a lower one. It costs less to get in, but the stock has to move even more for the trade to work. But see the idea? Both of these are just pure bets on a massive explosion in price. Okay, but let's flip that coin completely. Remember that question I asked right at the start? How do you make money when the market does, well, nothing? For that, we turn to a really cool strategy called the Iron Condor. Yeah, I know, the name sounds super intense, but the logic behind it is actually pretty straightforward. So an iron condor has 4 legs, but don't let that scare you. It's really just 2 different bets smushed together. First, you sell what's called a put spread below where the stock is trading right now. That's basically you betting the stock won't fall below a certain level. Then, you sell a call spread above the current price, which is your bet that it won't rise past a certain level. And by selling both of these, you get paid a premium, cash in your account right up front. And that's the whole point. What you've just done is create a profit zone, a range. And as long as the stock price stays chilling inside that range all the way until the options expire, all 4 of those options just become worthless. And that premium you collected when you opened the trade, yep, it's all yours. You literally made money because nothing happened. You sold volatility and you were right. Okay, look, we can sit here and talk about straddles and condors and all these cool strategies all day long. But I'm telling you, none of it means anything without this last and, honestly, most important piece of the puzzle. You could have the greatest strategy on earth, but it will absolutely fail if you don't have rock-solid discipline and risk management. This quote just nails it. The market itself is just a machine. It's rational. It's us. It's our human emotions, our fear, our greed, our fear of missing out, our panic, that sabotage everything. That's what turns a smart, logical plan into a total train wreck of impulsive decisions. The real battle you're fighting isn't against the market. It's against the person in the mirror. So how do you win that battle? With rules. Cold, hard rules. And the first, the most critical, the cardinal rule is this. You never, ever risk more than 1 or maybe 2% of your total account on any single trade. Look, this isn't about being scared. It's about staying alive. This one rule guarantees that a few bad trades in a row, and trust me, they will happen, don't knock you out of the game for good. And here they are, the classic mistakes that trip up almost every beginner. Trading with no plan at all, just winging it. Overtrading because you're emotional, especially that revenge trading you do after a loss, trying to win it back quick. Forgetting to set a stop loss, which is basically driving without brakes. And the biggest one, just abandoning your plan the second things get a little scary. Avoiding these, this is 90% of the work right here. And of course, I have to be super clear about this. Options are complicated. They carry a very high level of risk, and they are definitely not for everyone. It is possible to lose more than you initially put in. So please remember, everything we've talked about here is for educational purposes only, just to get you familiar with the ideas. So we'll leave you with this thought. Learning the strategies, understanding the Greeks, knowing the playbook, you know what? That's the easy part. The real challenge is personal. The market is going to test you, your rules, your emotions every single day. You might know exactly what you're supposed to do, but will you have the discipline to actually do it when the pressure is on and your money is on the line? That, right there, is the difference between a trader and a gambler. Thanks for tuning in.